When Hitler's regime collapsed in April 1945, Allied soldiers broke through sealed doors in a salt mine near Merkers, Germany, discovering over 100 tons of looted gold stored 2,000 feet underground. The soldiers who entered the mine initially expected to find ordinary military supplies. Instead, they walked into one of the greatest treasure discoveries in modern history. Massive stacks of gold bars lined the underground chambers. Bags filled with coins, crates of silver, and priceless artwork were scattered throughout the tunnels. This treasure had been seized from occupied nations and stolen from individuals across Europe. It represented wealth taken from central banks, governments, and countless families who had lost everything during the war. Yet this discovery represented only one small piece of a much larger story that was about to unfold. Within months, this gold discovery would trigger a silent war that would reshape the global financial system. It was not a war fought with tanks or aircraft. Instead, it was a struggle fought in central bank vaults, finance ministries, and economic conferences. The battlefield was global finance, and the weapon at the center of this struggle was gold. For more than 5,000 years, gold had served as the ultimate foundation of human commerce. Ancient civilizations valued it. Empires fought wars to obtain it. Kings stored it in their treasuries as a symbol of power. Throughout history, the nation controlling the world's gold reserves often controlled global trade itself. From the Spanish Empire that flooded Europe with gold and silver from the New World, to the British Empire that anchored its financial dominance on the gold standard, monetary power has always required metal in the vault. Gold was not simply a precious metal. It was the backbone of trust. Every currency system that claimed stability was ultimately anchored to gold reserves held by a government or central bank. But every reserve currency system eventually faces the same dangerous paradox. To maintain global dominance, the leading economic power must supply its currency to the rest of the world. Other countries need that currency to conduct international trade, settle debts, and build financial reserves. However, the more currency a nation exports abroad, the weaker its gold backing becomes. Over time, the amount of currency circulating around the world grows faster than the gold reserves supporting it. This creates a structural trap that has appeared repeatedly throughout history. Economists often describe this cycle as a four-stage collapse pattern. In the first stage, the dominant nation accumulates enormous gold reserves. This often happens through trade surpluses, economic dominance, or military victories. These gold reserves create strong confidence in the country's currency. In the second stage, the nation begins leveraging its monetary dominance. Because the world trusts its currency, the country can run persistent trade deficits. It imports goods while exporting its currency to pay for them. At first, this appears to be an extraordinary privilege. The country enjoys higher living standards, strong consumption, and global influence. But this privilege hides a growing vulnerability. In the third stage, foreign nations begin questioning whether enough gold exists to support the rapidly growing supply of currency. Central banks start calculating the numbers. They compare the amount of gold stored in vaults with the amount of currency circulating globally. If the math no longer works, confidence begins to erode. Foreign governments may then begin demanding conversion of currency into actual gold. This leads to the fourth and final stage. The dominant nation faces an impossible choice. It can attempt to defend the gold peg by raising interest rates, cutting spending, and imposing harsh economic policies. Or it can abandon the gold standard entirely, allowing its currency to float freely without metal backing. Every major reserve currency system in history has eventually faced this dilemma. After World War II, the United States appeared to have escaped this trap entirely. By 1947, the United States held approximately 20,000 metric tons of gold reserves. This represented nearly 70% of the world's official gold holdings. No empire in recorded history had ever achieved such overwhelming monetary concentration. The vast majority of the world's gold was now stored in American vaults. The most famous of these vaults was Fort Knox in Kentucky. Behind its thick granite walls and steel doors sat hundreds of millions of ounces of gold. The facility became legendary for its security. Guards, reinforced structures, and layers of protection surrounded the vaults. Inside, thousands of gold bars were stacked in massive underground chambers. The value stored there represented the financial backbone of the post-war world. Meanwhile, Europe lay financially devastated. The war had destroyed factories, infrastructure, and entire cities across the continent. Governments had spent enormous sums financing military operations. Many central banks had already depleted their gold reserves during the conflict. In addition, the Nazi regime had looted vast quantities of gold from occupied territories. The economic devastation was so severe that many countries struggled simply to rebuild basic infrastructure. During the war, the United States had emerged as the world's industrial powerhouse. American factories produced enormous quantities of tanks, aircraft, ships, and weapons for the Allied war effort. Through the Lend-Lease program, the United States supplied Allied nations with approximately $50 billion worth of military equipment, food, fuel, and raw materials. For many countries, this support was essential for survival. But these supplies were not entirely free. In many cases, payment was made in the form of gold transfers or dollar reserves. European governments shipped large quantities of gold to the United States to pay for wartime imports. As a result, gold flowed across the Atlantic throughout the early 1940s. While Europe burned, America's gold reserves grew larger and larger. By the time the war ended, the United States held the majority of the world's monetary metal. This enormous concentration of gold gave the United States unprecedented financial influence. But American policymakers recognized that the global economy needed stability after the chaos of war. Without a stable financial system, international trade would struggle to recover. Countries needed a framework that would allow currencies to remain stable while rebuilding their economies. This led to one of the most important financial conferences in modern history. In July 1944, representatives from 44 Allied nations gathered at a resort in Bretton Woods, New Hampshire. Their goal was to design a new international monetary system that would prevent the financial chaos that had contributed to the Great Depression. The conference produced what became known as the Bretton Woods system. Under this arrangement, each country's currency would be pegged to the US dollar within a narrow band. The dollar itself would remain convertible into gold at a fixed price of $35 per ounce. In effect, the dollar became the central pillar of the global financial system. Foreign governments could hold dollars as reserves, knowing they could theoretically convert those dollars into gold. The system essentially made the dollar as good as gold. However, this structure depended entirely on confidence in American gold reserves. As long as the United States possessed enormous gold stocks, the system could function smoothly. But hidden within the Bretton Woods framework was a fragile assumption. The system only worked if most countries chose not to convert their dollars into gold at the same time. If many governments demanded gold simultaneously, U.S. reserves could be drained rapidly. In other words, the stability of the entire system relied heavily on trust. At first, this trust seemed unshakable. The United States had the strongest economy in the world. Its industries dominated global production, and its gold reserves appeared massive. American leaders believed the Bretton Woods system could last indefinitely. For more than a decade, the system appeared to function remarkably well. Global trade expanded rapidly. Europe and Japan began rebuilding their economies. Currencies remained relatively stable, and the dollar became the world's most trusted financial asset. However, beneath this stability, the structural paradox remained. The United States needed to supply dollars to the global economy. Other countries required those dollars for trade and financial reserves. But every dollar sent abroad represented a potential claim on American gold. As long as those claims remained theoretical, the system could survive. But if nations ever began demanding real gold instead of paper dollars, the system could quickly unravel. At first, very few policymakers worried about this possibility. But one economist would soon warn that the system contained a fatal flaw. His name was Robert Triffin. In the late 1950s, Triffin carefully studied the structure of the Bretton Woods monetary system. What he discovered troubled him deeply. The system that appeared stable on the surface contained a mathematical contradiction that could eventually destroy it. In 1960, Triffin testified before the United States Congress and presented his warning. He explained that the global financial system depended on a steady supply of U.S. dollars circulating abroad. Countries needed dollars to conduct international trade, and to hold as reserves inside their central banks. But the only way for those dollars to reach the global economy was through American trade deficits or capital outflows. In simple terms, the United States had to send more dollars overseas than it received. This created a dangerous cycle. If the United States stopped exporting dollars and balanced its trade accounts, the global economy would suffer a shortage of liquidity. International trade could slow dramatically because countries would lack the dollars required to settle transactions. But if the United States continued exporting dollars through deficits, the total number of dollars held by foreign governments would grow larger and larger. Eventually, those foreign dollar claims could exceed the gold reserves backing them. If that happened, confidence in the system would begin to collapse. This contradiction became known as the Triffin dilemma. At the time, many policymakers dismissed Triffin's concerns as purely theoretical. The American economy was strong, and the Bretton Woods system seemed stable. But quietly, the numbers were already beginning to shift. By the early 1960s, foreign governments and central banks had accumulated enormous quantities of U.S. dollars. These dollars represented claims that could theoretically be exchanged for American gold. But the U.S. gold supply was not growing at the same pace. In fact, it was slowly declining. By 1961, a critical threshold had been crossed. Foreign dollar liabilities held by central banks had exceeded the total value of American gold reserves for the first time. This meant that if every country demanded gold simultaneously, the United States would not be able to fulfill those obligations. The numbers told a simple story. Foreign governments held roughly $21 billion in dollar claims. But U.S. gold reserves were worth only about $17 billion at the official $35 per ounce price. The gap would continue to widen throughout the decade. Meanwhile, the United States was entering a period of massive government spending. President Lyndon B. Johnson launched ambitious domestic programs known as the Great Society. These initiatives aimed to expand healthcare, education, and social welfare across the United States. At the same time, America became deeply involved in the escalating conflict in Southeast Asia, the Vietnam War. Fighting a major overseas war while funding large domestic programs placed enormous strain on government finances. Instead of raising taxes significantly, the government increasingly relied on borrowing. The Federal Reserve purchased large quantities of Treasury bonds, effectively expanding the money supply. More dollars entered circulation. Inflation began to rise. During the stable 1950s, American inflation had been relatively low. But by the mid-1960s, prices began climbing faster. This might not have alarmed ordinary citizens immediately, but foreign governments understood the deeper implications. Every dollar printed to finance deficits reduced the gold backing behind existing dollars. If a country held billions in dollar reserves, and the United States suddenly created billions more, the value of those reserves was quietly diluted. Central bankers around the world started doing the math. They compared America's gold reserves with the total dollar claims held abroad. The imbalance was becoming increasingly obvious. By the late 1960s, foreign dollar claims represented several times the amount of gold stored inside American vaults. At the official price of $35 per ounce, the numbers no longer made sense. One world leader decided to challenge the system openly. His name was Charles de Gaulle. De Gaulle was deeply skeptical of the Bretton Woods monetary structure. He believed the system gave the United States an unfair advantage. Because the dollar served as the world's reserve currency, the United States could finance international spending simply by printing paper money. Other nations were effectively forced to accept those dollars. In a famous speech delivered in 1965, de Gaulle criticized this arrangement. He argued that the system allowed the United States to enjoy what he described as an exorbitant privilege. America could run persistent deficits while other nations accumulated dollar reserves that might ultimately lose value. France decided to act. The French government began converting large portions of its dollar reserves into gold. Under the Bretton Woods Agreement, France had the legal right to exchange dollars for gold at the fixed price. So that is exactly what they did. Shipments of gold began leaving American vaults. French naval vessels reportedly crossed the Atlantic to transport gold bars from the United States back to the Bank of France. These were not small symbolic exchanges. They involved large quantities of physical metal. Between 1965 and 1969, France repatriated hundreds of tons of gold. The message was clear. France no longer trusted the long-term stability of the dollar-gold system. Other countries quietly noticed. Some began considering similar actions. Meanwhile, pressure on the gold price was growing in international markets. The official price remained fixed at $35 per ounce. But private investors increasingly believed gold should trade at a higher value. As demand increased, governments attempted to defend the official price through a coordinated effort known as the London Gold Pool. This agreement involved 8 major countries: the United States, the United Kingdom, France, West Germany, Italy, Belgium, the Netherlands, and Switzerland. Their goal was simple. If private demand pushed gold above $35 in the London market, the central banks would sell gold to bring the price back down. This required constant intervention. Large quantities of gold were supplied to the market to maintain the official price. For several years, the system managed to hold the line. But maintaining the peg became increasingly expensive. Speculators realized that the official price might eventually collapse. They began purchasing gold aggressively. Demand surged. The central banks were forced to sell enormous amounts of gold to maintain the $35 level. By the late 1960s, the London Gold Pool was hemorrhaging metal. Every attempt to defend the price required larger gold sales. Eventually, the pressure became too intense. In 1968, the system finally broke. The London Gold Pool collapsed. Governments abandoned efforts to control the private gold market. A new system emerged almost overnight. It became known as the two-tier gold market. Under this arrangement, official government transactions would continue at the $35 price. But private buyers and sellers could trade gold freely at market prices. Almost immediately, the private market price rose above $35. Gold reached approximately $40 per ounce. The difference between official pricing and market reality had become impossible to hide. The Bretton Woods system was beginning to fracture. But the most dramatic events were still ahead. By the early 1970s, pressure on the American gold reserves had intensified dramatically. Foreign governments continued accumulating dollars. At the same time, inflation in the United States continued rising. Many countries worried that their dollar reserves would lose purchasing power. Central banks quietly considered converting more of those dollars into gold. If enough countries acted simultaneously, it could trigger a massive run on American gold reserves. Inside Washington, policymakers were becoming increasingly concerned. The math was clear. U.S. gold reserves were shrinking. Foreign dollar claims were growing. Eventually, the system would reach a breaking point. And by 1971, that moment was rapidly approaching. By the early 1970s, the Bretton Woods system was standing on extremely fragile ground. Foreign governments had accumulated massive quantities of U.S. dollars, and confidence in the dollar's gold backing was weakening. Central bankers around the world understood that the total claims on American gold had grown far larger than the actual metal stored inside U.S. vaults. The numbers were impossible to ignore. U.S. gold reserves had fallen below 9,000 metric tons. Meanwhile, foreign governments held tens of billions of dollars that could theoretically be exchanged for gold at the official price of $35 per ounce. If even a portion of those countries demanded conversion at the same time, the United States could lose its remaining gold reserves within months. Pressure continued building throughout 1970 and early 1971. Several major economies were already beginning to reconsider their commitment to the fixed exchange rate system created at Bretton Woods Conference. Some countries were reluctant to continue absorbing American inflation by keeping their currencies tied to the dollar. In May 1971, West Germany made a dramatic move. The German government allowed the Deutsche Mark to float freely rather than maintaining its fixed exchange rate with the dollar. Soon afterward, Austria and other nations made similar decisions. These actions sent a powerful signal to global markets. Confidence in the Bretton Woods system was fading rapidly. Meanwhile, several governments continued requesting gold in exchange for their dollar reserves. The situation began to resemble a slow-moving bank run, not by ordinary citizens, but by entire nations. Inside the White House, President Richard Nixon and his advisors faced a difficult reality. America could not continue honoring unlimited gold conversions. If the gold outflow continued, the United States risked losing the remainder of its reserves. Something had to change. On August 15, 1971, Nixon delivered a televised address to the American public. During that speech, he announced one of the most dramatic financial decisions in modern history. The United States would suspend the convertibility of dollars into gold. This decision effectively closed what economists called the gold window. Foreign governments would no longer be able to exchange their dollar reserves for American gold. Nixon presented the move as a temporary measure designed to protect the U.S. economy from international currency speculators. But in reality, the decision marked the end of the Bretton Woods system. The link between the dollar and gold had been broken. For the first time in modern history, the global monetary system operated entirely on fiat currencies, money backed not by precious metals, but by government policy and public confidence. Although the suspension was initially described as temporary, the gold window never reopened. The world had entered a new era of floating exchange rates. By 1973, most major currencies had abandoned fixed exchange rate systems entirely. Instead of being tied to gold or the dollar, currencies now fluctuated freely based on market forces. The transition fundamentally changed the nature of global finance. Money was no longer anchored to physical metal. Instead, its value depended on economic strength, political stability, and the credibility of governments and central banks. But the United States still faced an important question. If the dollar was no longer backed by gold, why would the rest of the world continue holding it as a reserve currency? Without some form of global demand, the dollar's dominance could fade quickly. The answer emerged during another global crisis. In 1973, the world experienced a massive oil shock triggered by the 1973 oil crisis. Oil prices surged dramatically, and energy became the most critical commodity in global trade. Recognizing the opportunity, the United States negotiated a series of strategic agreements with Saudi Arabia. Under these agreements, Saudi Arabia agreed to price all of its oil exports exclusively in U.S. dollars. Other members of the OPEC gradually adopted the same practice. This arrangement created what later became known as the petrodollar system. The structure was simple but powerful. Every country that needed to purchase oil, which meant virtually every industrialized nation, first had to obtain U.S. dollars. This created constant global demand for the American currency. Oil exporting countries accumulated enormous quantities of dollars from energy sales. Many of those dollars were then reinvested in U.S. Treasury bonds and American financial markets. This recycling process became known as petrodollar recycling. The system effectively replaced gold backing with energy demand. Instead of being convertible into gold, the dollar became the primary currency used to buy the world's most important resource. For decades, this arrangement reinforced American financial dominance. Global trade continued expanding, and the dollar remained the central reserve currency of the international system. But over time, some nations began questioning whether this structure would last forever. Large economies such as China and Russia started exploring ways to reduce their dependence on the dollar. One strategy involved increasing their gold reserves. Gold still possessed a unique advantage. Unlike paper currencies or government bonds, gold carried no counterparty risk. It did not depend on the policies of another country. During the early 21st century, central banks around the world began steadily increasing their gold holdings. The pace accelerated significantly after the global financial crisis of 2008. Many policymakers concluded that excessive reliance on a single reserve currency created potential vulnerabilities. As a result, gold began regaining importance as a strategic financial asset. In recent years, global central banks have purchased gold at the fastest pace in decades. Countries across Asia, the Middle East, and Eastern Europe have added large quantities of metal to their reserves. Some analysts view this trend as a sign that the world may be entering a new phase of monetary competition. Just as France challenged dollar dominance during the 1960s, modern powers may be preparing for a future where the global financial system becomes more multipolar. The exact outcome remains uncertain. The U.S. dollar still dominates international trade, financial markets, and global reserves. American Treasury securities remain among the most widely held assets in the world. Yet history suggests that no monetary system lasts forever. Every reserve currency eventually faces pressures created by deficits, geopolitical shifts, and changing economic realities. The story that began in 1945, when Allied soldiers uncovered hidden Nazi gold inside a German salt mine, ultimately evolved into a global struggle over money itself. That struggle continues today. Gold still sits inside central bank vaults around the world. Currencies continue rising and falling in global markets. And nations still compete for influence over the financial system that powers the modern economy. The silent war over money has never truly ended. It has simply changed form.